All right, today we are digging into the specialty chemicals company Croda International. Now, this company was a total rock star on the stock market for years, but lately it's hit a major wall. So the big question for investors is this a temporary blip or is something fundamentally broken?
And that right there is the classic dilemma, isn't it? When a company you know is high quality sees its stock get hammered, you have to decide, is this my chance to buy a fantastic business at a discount? Or is this a massive red flag telling me to stay away? That's exactly what we're here to figure out with Croda.
So to really get to the bottom of this, we first have to understand what made Croda so special in the first place. What was their secret sauce? What was their magic?
Well, at the very heart of Croda's business is this brilliant strategy they call high-value, low-inclusion. Basically, they supply these highly innovative, super important ingredients that are just a tiny, tiny fraction of their customers' total product cost. But, and this is the key, their little ingredient is absolutely essential to making the final product work. Think about that special something that makes a luxury face cream feel amazing. That could be from Croda.
And the benefits of this model are just huge. First off, because their ingredient is such a small piece of the cost pie, Croda can charge premium prices. Their customers are way less likely to haggle. It also means they get deeply embedded with their customers' R&D teams, which creates incredibly high switching costs. Who would want to reformulate an entire product just to save a few pennies? And the result of all that? Just beautiful, historically high profit margins.
So if the business model is so good, what in the world went wrong? Well, that brings us to part 2 of the story, the great destocking shock. This is when the music for Croda pretty much just stopped.
And look at this timeline. The whiplash here is just incredible. You had this huge post-pandemic boom in 2021, hitting a massive peak in 2022, and then, bam, the floor just fell out in 2023. All those customers who'd been building up inventory suddenly just stopped ordering. And even though sales are kind of stabilizing now, you can see the profits are still way, way down. The hard numbers really paint a picture, don't they? Just look at the difference between the peak in 2022 and where things are now. Yeah, revenue fell, but look at the operating profit. It was practically cut in half. The profit margin went from a super healthy almost 25% down to 17%. And return on invested capital, a really key measure of how well a company uses its money, got sliced right down the middle. Oof, the damage was real.
So what happened? Well, it was a total perfect storm. First, you had all this pandemic-era stockpiling, where customers bought way more than they needed just in case. Then, as the economy started to look a little shaky, everyone slammed on the brakes and started burning through that extra inventory all at once. That's the great destocking. And on top of all that, raw material costs were just skyrocketing. It was a brutal 1-2-3 punch.
And listen, you don't have to take my word for it. This quote from management during the worst of it says everything. They admitted that they could only see about 2 weeks into the future with their orders. For a business of this scale, that's like trying to navigate a supertanker in a fog bank. You're basically flying blind. Now, this is a really crucial point for any investor. This whole episode exposed a hidden vulnerability in Croda's otherwise awesome model, something called negative operational leverage. In simple terms, they have these massive, expensive factories with high fixed costs. So when sales volumes drop, profits fall way faster. The cost of keeping the lights on doesn't change, so every single lost sale just demolishes the bottom line.
So, what's management doing about all this? Well, they're not just sitting around hoping for things to get better. They are actively pivoting the entire company toward a brand new future.
And here's what that new Croda looks like today. They've been selling off some of their more commoditized industrial businesses to really zero in on 2 key areas. Consumer care, so think skincare, beauty, that kind of thing, and life sciences, which covers pharma and agriculture. It's a much more focused and hopefully higher growth company now.
And this isn't just a small tweak, it's a major strategic shift. They're moving away from those more cyclical, old-school industrial chemicals and doubling down on really cutting-edge stuff like biologics and sustainable ingredients. What's also interesting is their focus on smaller, more nimble brands, which are often growing a lot faster than the giant global players.
So where's the future growth going to come from? Well, it's right here. In pharma, it's all about things like the specialty lipids needed for mRNA vaccines. In beauty, it's high-tech, natural ingredients from recent acquisitions. And in agriculture, they're getting way ahead of the curve with sustainable products like microplastic-free seed coatings. These are the engines that are supposed to power the comeback.
And to fix that big profitability problem we talked about, management has put a massive number on the board. £100 million in annual cost savings. Now, this isn't just about nickel and diming. It's a huge strategic effort to rebuild those margins and get the financial engine firing on all cylinders again. Okay, so all of that brings us right back to the central question for anyone looking at this stock. After all this chaos and all these strategic moves, is Croda now a bargain, a value trap, or a genuine turnaround story in the making? Let's talk valuation, because this is where it gets really interesting. If you look at the price-to-earnings ratio, a common way to value a stock, you'll see investors used to happily pay over 25 times what the company was expected to earn. Today, that's down to around 17. On paper at least, the stock looks a whole lot cheaper than it used to be. And we see the exact same story with another key metric, EV to EBITDA. The stock's 5-year average multiple was north of 22. Today, it's hovering around 11. I mean, it has literally been cut in half. The message from the market is crystal clear. The premium valuation that Croda used to enjoy is gone, at least for now.
So here it is, the showdown. The bull case is pretty straightforward. You've got a fantastic business model that's on sale, it's pivoting to all the right high growth areas, and the valuation looks cheap compared to its own history. But the bear case is powerful too. They'll tell you the recovery will be slow, getting those margins back up will be a real grind, and there's a real risk that the stock never gets that premium price tag back.
Okay, so if you're watching Croda from the sidelines or you're already an investor, what are the key things to look for? Here's your checklist. First, you need to see sales volumes picking up again, consistently. Second, keep a close eye on that operating margin. Is it starting to climb back towards that 20% plus level? Third, are their new products still selling like hotcakes? And finally, are they actually delivering on that huge £100 million cost savings plan? Ultimately, it all comes down to this single question. Croda's whole brand is built around this idea of smart science to improve lives. The question for us as investors is whether that smart science, combined with this new, leaner strategy, can once again deliver the kind of smarter returns that made this company famous. And that, my friends, is the multi-billion-dollar question.